Hi, welcome to RecTV Education. In the last video, we have seen a part of customs duty. Now, in this video, let us see the remaining topic of customs duty. Exemption from customs duty. The government may give two types of exemptions in customs duty. One is a general exemption and another one is a special exemption. Central government give a general exemption by notification in the official gazette under specified conditions. Special exemption. Special exemption. Central government gives a special exemption by a specific order only under the certain exceptional conditions from payment of customs duty. In order to pay a customs duty, whether imported duty or exported duty, we need a certain value on which some rate is applicable and some rate is applied and calculated. Now let's see how to value such type of goods. Where customs duty is chargeable on ad valorem basis, there are two types how we can value the imported or exported goods. One is on the basis of transaction value and another one is on the basis of tariff value. Where customs duty is chargeable on the basis of transaction value, the following points need to be considered. The price actually paid or payable for the goods when sold for export to or from India, for delivery at time and place of importation or exportation, where buyer and seller of the goods are not related. The main important and the last point is price is the sole consideration for the sale. Such other conditions as specified. In short, if we see while calculating the problems on the basis of this transaction value, the 5 points need to be kept in everyone's mind. First one is prices are the only sole consideration for the sale. The buyer and seller need not to be related, and the sale is for export or import. The delivery at the time and place of importation and exportation, price has to be actually paid or payable for the sale. Date relevant for determination of rate of exchange. In case of imported goods, a rate of exchange as notified by CBEC as on the date prevalent on date of filling of bill of entry. In case of exported goods, a rate of exchange as notified by CBEC prevalent as on the date of filling of bill of entry in case export by vehicle, or date of filling of shipping bill in case of export by vessel or aircraft. We have already seen in the above section that in case of an exports, the rate of exchange is as notified by the CBEC as on the date of prevailing of presentation of shipping bill in case of export by vessel or an aircraft. Now, if we look into this example, here the date of presentation of shipping bill is 18th June 2014 and date of entry outwards is 26th June 2014. And the exchange rate notified by CBEC is 89 and 85, and exchange rate notified by RBI is 90 and 87. Now we have to look into this example. The only point is the date of presentation of shipping bill is to be taken whether for exchange rate whether notified by CBEC or by exchange rate notified by RBI. But as per according to the above section, it is the exchange rate notified by CBEC. So the answer for the following example is the date is 18th June 2014 and the rate of exchange is 89 per UK pound. One of the very important topic in customs duty. Date of determination of rate of duty and tariff valuation of imported goods. In case of goods for home consumption, the rate of duty and the valuation of imported goods as on the date of presentation of bill of entry or on the date of entry inwards, whichever is later. In case of goods cleared for home consumption from warehouse, date of presenting of bill entry is the date for the determination of a rate of duty and tariff valuation of imported goods. In case of any other goods, the date of payment of duty. Let us understand the previous section by using a following simple example. Here in the given example, the date of bill of entry is 5th June 2014 and date of arrival of aircraft is 15th June 2014. Here the question arises, which rate of customs duty is to be considered? For this question, if we consider the above section, here it is given that the date of bill of entry or the date of arrival of aircraft, whichever is later. So, considering the above section in the given example, here the date of arrival of aircraft is 15 June 2014. That is, if we see the following two dates, the whichever is later is 15 June 2014. Therefore, the relevant rate of duty applicable is 11%. Date for determination of the rate of duty and tariff valuation in case of export goods. In case of goods entered for export, the date on which proper officer makes an order permitting clearance and loading of goods for exportation. In case of any other goods, the date of payment of duty. Various types of customs duties. Basic customs duties, countervailing duties or additional customs duties, special countervailing duties, protective duties, safeguard duties, countervailing duty on subsidized articles, anti-dumping duty. Now let us discuss one by one. First type of customs duty, basic customs duty. This duty is levied on any imported or export goods at the rates specified under Customs Tariff Act on transaction value or tariff value already determined under Section 14(2) of Customs Act 1962. Additional customs duty or countervailing duty. It is duty imposed on any imported article equal to excise duty if on a like article if produced or manufactured in India at a rate of excise duty leviable on a like article if produced or manufactured in India. Special countervailing duty. It is the duty levied on any imported article to counterbalance the sales tax, VAT, local tax or any other charges for the time being in force levied on a like article on its sale, purchase or transportation in India at the rate as notified by central government but not exceeding 4%. Protective duties. It is a duty imposed on imported articles for the protection of interest of any industry established in India on the recommendation of Tariff Commission. Safeguard duty. Duty levied if the central government is satisfied that any article is imported into India in increased quantities and such importation is causing or threatening to cause a serious injury to domestic industry. Countervailing duty on subsidized articles. It is imposed if any country or territory directly or indirectly pays subsidy upon the manufacture or production or exportation of any article. Such articles are exported into India. The importation may or may not directly be from the country of manufacture or production, and the article may be in the same condition as when exported from country of manufacture or production or may be in any other form. Anti-dumping duty. Where any article is exported by an exporter to India at less than its normal value, then upon the importation of such article into India, The central government may impose an anti-dumping duty not exceeding the margin of dumping in relation to such article. Here, margin of dumping equals to nominal value minus export price. With this, we have completed a customs duty very successfully. I hope you guys enjoyed this video. Subscribe to Rec TV. Thank you.